What are stocks? Stocks, sometimes called shares or equities, represent ownership in a company. When you buy a stock, you're purchasing a small piece of that business. This ownership gives you certain rights, such as sharing in the company's profits, and sometimes even having a vote in important company decisions. For example, if a company issues 1 million shares and you own 1,000 of them, you own 0.1% of that company. The value of your shares will rise or fall depending on how the company performs and how other investors feel about its future. Owning stocks doesn't mean you can walk into the company's office and start making decisions. Instead, it means you have a financial stake in the company's success or failure. Why companies issue stocks? Companies issue stocks primarily to raise money. Starting or expanding a business often requires huge amounts of capital. Buying equipment, hiring staff, opening new branches, or developing new products. Instead of taking on debt from banks, many companies decide to go public. They do this through a process called an initial public offering, IPO. In an IPO, a company sells part of its ownership to the public in the form of shares. The money raised from the sale of these shares is used to fund the company's growth. In return, investors who buy the shares hope the company will do well, so the value of their investment increases. How stocks are traded. Once a company issues stocks, they are bought and sold on stock exchanges. Think of a stock exchange as a huge digital marketplace where buyers and sellers come together. Some of the most famous exchanges include the New York Stock Exchange, NYSE, and NASDAQ in the United States, as well as the London Stock Exchange and Tokyo Stock Exchange internationally. In the past, trading stocks often required physically calling a broker or visiting the exchange floor. Today, almost all trading happens online. Anyone with a computer or smartphone and a brokerage account can buy or sell shares with just a few clicks. The price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price drops. How investors make money. Investors generally earn money from stocks in two main ways: dividends and capital gains. Dividends. Some companies pay a portion of their profits to shareholders in the form of dividends, usually every quarter. These payments give investors a regular income, even if the stock's price doesn't increase. Capital gains. If you buy a stock at a lower price and later sell it for a higher price, the profit you make is called a capital gain. For example, if you buy a share for $50 and sell it for $80, you've earned a $30 capital gain per share. However, it's important to note that stock prices can also fall. If you sell a stock for less than what you paid, you incur a capital loss. Types of stocks. Not all stocks are the same. The two main categories are common stocks and preferred stocks. Common stocks. These are the most popular type. Owners often get voting rights in company decisions and may receive dividends. Common stockholders typically benefit the most if a company grows and performs well, as the share price tends to rise. Preferred stocks. These don't usually offer voting rights, but provide a more predictable income. Preferred shareholders get priority when it comes to dividend payments and are paid before common shareholders if the company goes bankrupt. Investors often choose common stocks for growth potential and preferred stocks for stability and steady income. Risks of stock investing. While stocks can be a powerful way to grow wealth, they also come with risks. Stock prices can rise or fall quickly due to company performance, market conditions, or even global events like pandemics or political crises. Unlike a savings account, where your money is generally safe and grows slowly with interest, investing in stocks carries no guarantee. If a company fails or the market drops, your investment can lose value. This is why financial experts often recommend diversification, spreading your investments across many companies and industries so that one bad investment doesn't wipe out all your savings. Long-term growth and compounding. Despite short-term risks, stocks have historically provided strong returns over the long term. Many investors buy and hold stocks for years or even decades, allowing their money to grow as the companies they've invested in grow. This long-term approach also benefits from compounding. When you reinvest dividends or profits back into more stocks, your investment grows not only from your initial money, but also from the returns it generates. Over time, this compounding effect can significantly increase your wealth. Role of brokers and online platforms. To access stock markets, most investors use brokers. In the past, these were professional advisors who handled trades for a fee. Today, many people use online platforms such as Robinhood, ETRADE, or Fidelity. These platforms make investing more accessible and often charge very low or even zero commissions. They also offer research tools, charts, and educational resources to help investors make informed decisions. For beginners, these platforms are an easy way to start investing without needing extensive financial knowledge. The market's global reach stocks are not limited to one country. Investors can buy shares of companies listed on foreign exchanges, offering opportunities to invest in businesses all over the world. For example, an investor in the United States can buy stocks of companies in Europe, Asia, or anywhere else. This global reach allows investors to diversify their portfolios across different regions and economies. Global markets are interconnected. News or events in one part of the world can impact stock prices elsewhere. For example, a trade policy change in China might influence tech companies listed in the US. The psychology of investing emotions play a big role in stock market behavior. Investors often react to fear, greed, or excitement, which can cause sharp price swings. For example, during a market panic, many people may rush to sell their stocks, pushing prices lower. In contrast, during a booming market, investors may rush to buy, driving prices higher. Successful investing often requires discipline, sticking to a strategy and avoiding impulsive decisions based on short-term market movements. Stocks and wealth-building stocks have become one of the most popular ways for people to build long-term wealth. Many individuals include stocks in their retirement accounts, such as 401ks or IRAs, to help their savings grow over time. The key to using stocks for wealth building is consistency and patience. By investing regularly and holding on to quality stocks for many years, investors can benefit from both the growth of the companies and the overall economy. The big picture of stocks. At their core, stocks are a way for businesses to raise money and for individuals to participate in the growth of those businesses. They represent a partnership between companies and investors. Companies get the capital they need to innovate and expand, while investors share in the rewards of that growth. Understanding how stocks work helps investors make informed decisions, balance risks and rewards, and use the stock market as a tool for achieving long-term financial goals.